You know what a God candle is, right? It's that massive green bar on a price chart that makes everything before it look like noise. The kind of move that changes portfolios overnight. The kind that separates those who saw it coming from those who didn't. And right now, every piece of data I'm looking at suggests we're about to witness one in precious metals that will make previous rallies look like warm-up acts. Let me show you exactly what's happening beneath the surface, because this isn't speculation. This is pattern recognition based on forces that are already in motion. Silver just posted a gain that's nearly double what gold achieved over the same period. We're talking about a metal that's been in the shadows for years, suddenly exploding with the kind of momentum that typically precedes something much bigger. When silver starts outpacing gold by this margin, it's not random. It's a signal that industrial demand, investment demand, and supply constraints are colliding in a way that creates explosive price action. But here's what most people miss. They see the price movement and think they've missed it. They don't realize that what we've seen so far is just the setup. The real move hasn't even started yet. Think about what's driving this. Central banks have been accumulating gold at a pace we haven't seen in decades. Not just any central banks either. We're talking about major players who are actively diversifying away from dollar-denominated assets. They're not doing this because they think gold might go up a little. They're doing this because they're preparing for a fundamental shift in the global monetary system. And when central banks move, they move with information that retail investors don't have access to until months or years later. They're seeing the same debt levels, the same currency debasement, the same geopolitical fractures that we are, but they're acting on it with the kind of conviction that comes from understanding what happens next. Now let's talk about silver specifically, because this is where things get really interesting. Silver has this unique characteristic where it's both a monetary metal and an industrial metal. That dual nature creates a supply-demand dynamic that's unlike anything else in the commodity space. On the industrial side, silver is absolutely critical for solar panels, electric vehicles, electronics, and emerging technologies. As the world pushes toward electrification and renewable energy, silver demand from these sectors isn't just growing, it's accelerating. And here's the kicker. Mine production has been declining. We're using more silver than we're pulling out of the ground, and that deficit is widening. But the monetary side is what's really fascinating right now. Investment demand for silver has been surging as investors recognize that it's massively undervalued relative to gold. The gold-to-silver ratio, which historically averages around 60 to 1, has been way out of whack for years. When that ratio starts compressing, as it's beginning to do now, silver doesn't just catch up to gold, it explodes past it. We've seen this movie before. In the late 70s, silver went from around $5 an ounce to $50 in a matter of months. That wasn't because of some random speculation. It was because the same forces we're seeing today, monetary instability, inflation concerns, and supply constraints, created a perfect storm that sent prices parabolic. And here's what people forget about that era. The move didn't happen all at once. There were stages. First, you had the slow accumulation phase where smart money was quietly building positions. Then you had the breakout phase where prices started moving but most people still thought it was temporary. And then you had the parabolic phase where prices went vertical, and everyone who waited was left scrambling to get in at much higher levels. Right now, we're somewhere between the breakout phase and the parabolic phase. The smart money has already positioned. The breakout is happening. But the real vertical move, the God candle, is still loading. Let me give you some context on what's happening in the physical market, because this is where you see the real stress building. Premiums on physical silver, the amount you pay above the spot price to actually get your hands on the metal, have been elevated for months. That tells you that demand for physical metal is outstripping what's immediately available. Dealers are reporting delays. Mints are struggling to keep up with demand. And this is happening while the paper price, the price you see quoted on exchanges, is still relatively contained. That disconnect between physical and paper markets is a classic sign that the paper market is about to catch up to reality in a violent way. Because here's the thing about precious metals markets. They're heavily influenced by paper contracts, futures, and options that represent far more metal than actually exists. As long as most people are content to trade paper, the system works. But when people start demanding physical delivery, when they want the actual metal in their hands, that's when the whole structure gets tested. And we're starting to see signs that physical demand is overwhelming the paper market's ability to deliver. When that happens, prices don't adjust gradually. They gap up. They move in ways that leave traditional technical analysis in the dust. Now, I want to talk about something that doesn't get enough attention, and that's the role of the COMEX in all of this. The COMEX is where most silver futures trading happens, and it's been the subject of controversy for years because of concerns about price manipulation and the ratio of paper contracts to physical metal. Here's what matters. The COMEX has rules about position limits and delivery obligations, but those rules are designed for normal market conditions. When you get a situation where a large number of contract holders decide they want physical delivery, instead of just rolling their positions forward, the exchange can face a serious problem. We've seen glimpses of this stress before. There have been moments where the COMEX had to scramble to source physical metal to meet delivery obligations, and each time that happens it reveals just how thin the actual physical supply is compared to the paper claims on that supply. If we get a situation where a significant portion of contract holders stand for delivery, where they say we want the actual metal, not just the paper promise, you could see a short squeeze that makes previous moves look tame. Because the entities that are short those contracts would have to either deliver metal they don't have or buy it at whatever price necessary to cover their obligations. That's your God candle scenario. That's the kind of move that happens when market structure breaks down and price has to adjust to reality all at once instead of gradually. Let me paint you a picture of what this looks like in practice. Imagine you're a large institution that's been shorting silver futures as part of a hedging strategy or a bet that prices would stay contained. You've been rolling those positions forward month after month, never actually having to deliver physical metal because most contract holders just settle in cash or roll forward themselves. But then something changes. Maybe it's a geopolitical event. Maybe it's a currency crisis. Maybe it's just a critical mass of investors deciding they want physical exposure. Suddenly, you're facing delivery obligations that you can't meet with the metal you have on hand. So you go into the physical market to buy. But so is everyone else in your position. And the physical market, unlike the paper market, has real constraints. There's only so much metal available at any given price. As you and others start bidding for that limited supply, prices start rising. Fast. And here's where it gets really interesting. As prices rise, it triggers stop losses and margin calls on other short positions. Those entities are now forced to buy as well, adding more fuel to the fire. Meanwhile, investors who were on the sidelines see prices moving and decide they need to get in before it goes higher. That's your momentum buyers adding even more demand. This is how you get a God candle. This is how prices can move 30, 40, 50% in a matter of days or even hours. It's not because of some fundamental change in the metal itself, it's because the market structure that was keeping prices artificially contained suddenly breaks, and price has to find a new equilibrium that reflects actual supply and demand. Now, let's talk about gold for a moment, because what happens in gold has massive implications for silver. Gold has been making new all-time highs, and it's doing so in an environment where real interest rates are elevated. Traditionally, higher real rates are supposed to be negative for gold because gold doesn't pay interest. The fact that gold is rallying despite this headwind tells you that something bigger is at play. What's at play is a loss of confidence in fiat currencies and the institutions that manage them. When central banks are buying gold at record levels, when countries are actively working to reduce their dependence on the dollar, when debt levels are at historic highs with no credible plan to address them, gold becomes the ultimate safe haven. And when gold moves, silver follows. But it doesn't just follow proportionally. Because of silver's smaller market size and its industrial demand component, it tends to amplify gold's moves. If gold goes up 20%, silver might go up 40 or 50%. That leverage is what makes silver so attractive to investors who understand the dynamics at play. Quick aside here, because this is relevant if you're thinking about how to position for this. If you're sitting on a significant amount in retirement accounts, there are ways to get exposure to physical precious metals within those accounts without triggering tax penalties. I put together a guide on how gold IRAs work. It's in the description if you want to check it out. Covers the mechanics, the rules, what to watch out for. Worth looking at if you're thinking about protecting retirement savings with hard assets. Anyway, back to where this is headed, because the question isn't really whether precious metals are going higher. The data, the fundamentals, the technical setup, all of it points in the same direction. The question is how high and how fast. And that's where understanding market psychology becomes critical. Markets don't move in straight lines. They move in waves, with periods of consolidation followed by explosive moves. Right now, we're in a consolidation phase after a significant run-up. Prices are building energy, coiling like a spring. When that spring releases, when we get the catalyst that breaks prices out of this consolidation, that's when you see the kind of move that defines a market cycle. That's your God candle. What could that catalyst be? There are several possibilities. It could be a geopolitical event that sends investors rushing into safe havens. It could be a currency crisis in a major economy. It could be an inflation print that's significantly higher than expected, forcing a reassessment of real rates. It could be a default or restructuring of sovereign debt that calls into question the stability of the entire financial system. Or it could be something in the physical market itself. A major mine closure, a supply disruption, a large buyer entering the market and soaking up available supply. The specific trigger almost doesn't matter because the underlying conditions are already in place. The trigger is just what lights the fuse. And here's what's fascinating about where we are right now. We're at a point where multiple potential triggers are in place simultaneously. Geopolitical tensions are elevated. Currency concerns are growing. Inflation remains persistent despite central bank efforts. Debt levels continue to climb. Any one of these could be the spark. But even without a specific catalyst, the structural forces at play are powerful enough to drive prices significantly higher. The supply-demand imbalance in silver isn't going away. Central bank buying of gold isn't slowing down. The move away from dollar dominance is accelerating. These are trends that play out over years, not weeks or months. What that means is that even if we don't get a dramatic catalyst in the near term, the long-term trajectory is clear. Precious metals are in a bull market that has years left to run. The God candle might come sooner or later, but it's coming. Now let me address something that I know some of you are thinking. You're looking at the current prices and thinking they're already high. You're worried about buying at what might be a local top. That's a natural concern, but it's also a concern that causes people to miss major moves. Here's the reality. In a bull market, prices make new highs regularly. Each new high feels expensive compared to where prices were before. But in hindsight, those highs that felt expensive become the lows that people wish they had bought at. Think about gold at $2,000. When it first hit that level, people thought it was expensive. Now it's trading well above that, and $2,000 looks like a bargain. The same thing will happen with current levels. When silver is at $60 or $80 or $100 an ounce, people will look back at current prices and wonder why they hesitated. The key is understanding the difference between price and value. Price is what you pay. Value is what you get. And right now, despite the recent run-up, precious metals are still undervalued relative to the monetary expansion, the debt levels, and the geopolitical risks we're facing. Let me give you some numbers to put this in perspective. The total value of all the silver ever mined is a tiny fraction of the total value of global financial assets. We're talking about a market that's so small that even a modest shift in allocation from traditional assets into silver could send prices exponentially higher. Compare that to the stock market, the bond market, or real estate. Those are massive markets where it takes enormous amounts of capital to move prices significantly. Silver is the opposite. It's a small market where relatively modest capital flows can have outsized impacts on price. That's both an opportunity and a risk. The opportunity is that you can get significant exposure with a relatively small position. The risk is that when the move happens, it can be so fast that you don't have time to react if you're not already positioned. And that's really the message here. The God candle is loading. The conditions are in place. The fundamentals are aligned. The technical setup is coiling. The only question is timing, and timing is the one thing that's impossible to predict with precision. What you can do is recognize the setup and position accordingly. Not with money you need next month or next year, but with capital that you can allocate to an asset that has the potential to significantly outperform over the next several years. Because here's what I've learned from watching markets for years. The biggest gains don't come from being clever or timing things perfectly. They come from recognizing major trends early and having the conviction to stay positioned even when things get volatile. Precious metals are volatile. They always have been. There will be pullbacks. There will be moments of doubt. There will be times when it feels like the thesis isn't working. But if you understand the underlying forces at play, those pullbacks become opportunities rather than reasons to panic. Think about the investors who bought gold in the early 2000s when it was trading at $300 an ounce. They had to sit through multiple corrections and periods of consolidation, but they also got to participate in a move that took gold to over $1,900 at its peak. That's the kind of return that changes financial outcomes. We're potentially at a similar inflection point now. Not at the beginning of the bull market, we're already well into it, but before the parabolic phase that typically marks the final stage of a major bull run. And here's the thing about parabolic phases. They're where the majority of the gains happen. You can have a bull market that lasts 5 years, but the bulk of the price appreciation might happen in the final 6 to 12 months. That's when prices go vertical. That's when the God candle appears. Missing that final phase means missing the majority of the potential return, And the only way to ensure you don't miss it is to be positioned before it happens, because once it starts, it moves too fast to catch. So where does this leave us? We have precious metals that have already had a significant run, but are showing signs of building energy for another leg higher. We have fundamental drivers that are not only intact, but strengthening. We have technical setups that suggest consolidation before continuation. And we have a market structure in silver specifically that's vulnerable to a short squeeze that could send prices parabolic. The God candle is loading. The question is whether you'll be positioned when it fires, because when it does, it won't wait for anyone. It won't give you time to think about it, or do more research, or wait for a better entry point. It will just happen, and those who are ready will benefit while those who aren't will watch from the sidelines. This isn't about fear or greed. It's about recognizing patterns and understanding market dynamics. It's about seeing what's happening beneath the surface and acting on that information before it becomes obvious to everyone else. The smart money is already positioned. Central banks are already accumulating. Industrial users are already securing supply. The only question is whether individual investors will recognize what's happening in time to participate in what could be one of the most significant moves in precious metals we've seen in decades. The setup is there, the fundamentals are there, the technical pattern is there. All that's missing is the catalyst. And in a market this primed, that catalyst could come at any moment. When it does, the God candle will load, and those who understood what was coming will be the ones who benefit from the move that follows.